Good morning. I'm Tim Nyland, and today we are going to discuss an advanced strategy for broadening your approach to equity valuation. The strategy focal point is the unique way I utilize the Zacks Rank, and this approach can be implemented into virtually any investment process. I'm going to illustrate the steps I take using the Zacks Valuation Model, but again, it does not require the use of the Zacks Valuation Model. So as we are moving through the concepts, I would like for you to think of your own existing framework and how this strategy could be used to enrich your stock selection process. Before we get started, please like, comment, and subscribe, and come back every week for more videos on investing strategy and making the most of Zacks Pro platforms. If you'd like to do the kind of analysis you're going to see in this video, then you'll need to have a ZAT Portfolio Manager subscription, which includes both Zacks Advisor Tools and the Zacks Research System. In today's webinar, we are going to continue to pick on Microsoft a little bit, then we're going to move on to Apple and Amazon, and we're going to build on the concepts we discussed in part 2 of the Lost Decade in Stock series. Recall that from our prior discussion on Microsoft, we looked at the implied PE ratio, assuming the equity risk premium and 10-year treasury yield were going to revert to the 20-year median levels over time. So in other words, in part 2 of the Lost Decade in Stocks, we modeled changes in macro factors. Today, we're going to use the Zacks Rank as a basis to model changes in company-specific valuation factors. And on the screen, you can see circled in red is the Lost Decade Part 2. I would encourage you to have a look at that webinar if you have not had a chance to see it yet. So if you've watched a few of these webinars, you've probably heard me refer to the Zacks Rank. It is the quantitative model that drives our award-winning equity, ETF, and mutual fund research, and is an essential part of the stock picking process for thousands of institutional investors, hedge funds, and retail investors. These models developed through our quantitative research division, QuantLab, allow you to perform sophisticated equity analysis using key variables such as consistency and quality of earnings, response to earnings announcements, insider buy-sell transactions, and many others. If you'd like to learn more about these powerful models and how to use them in your process, then click the link in the description below this video to download a free copy of the Zacks QuantLab Models Guide. Now I'm going to show you the unique way that I use the Zacks Rank, and I would encourage you to download a free copy of the Zacks Rank Guide by clicking the link in the description below. So what is the Zacks Rank, and why should we really care about it? Right out of the Zacks Rank Guide, I've got a copy on the screen here, talks about how it's calculated, and it's centric to estimate revisions, specifically agreement, magnitude, upside potential, and estimate surprise. I'm not going to go through the details specifically, but this is available for download, and I would encourage everyone to have a look at it. So in utilizing Zacks Rank for stocks, it's mainly used as a timing tool rather than a method of picking long-term outperformers. And you can see that we have 4 of the use cases here up on the screen, and I've circled the multi-factor models in red. This is where we are going to focus. So let's take again a look at the unique way I use the Zacks Rank and multi-factor modeling. I like to classify multi-factor models into 2 types, right? You've got your black box models. This is where the Zacks Rank can be used as an input factor into a larger traditional quantitative model to receive results such as a buy, a sell, or a hold. Typically, this type of an output is associated with a raw score and a weighted score. So these are going to be your traditional quantitative models that are utilized by hedge funds, multi-factor ranking models, as well as Monte Carlo styled factor sensitivity analysis. Where we are going to focus our energy today is on point number 2, and this is the interactive valuation modeling side. So here's where we can use the Zacks Rank as an input factor to determine trend confirmation or a breakdown or reversal in EPS forecast trajectory. Clearly, this is an analytical issue of relevance. It can be modeled interactively, and this is the unique way that I utilize the Zacks Rank. I use the Zacks Valuation Model, but what I'm going to show you can be utilized across any third-party or even your own proprietary valuation models. We're going to do this interactively using the Zacks Research System, so I'm going to go ahead and move over there now. So as we move through the first of our 3 names that we're going to be looking at today, you'll notice that I am currently on the price and earnings chart in the Zacks Research System. And the first thing I notice is that we have a Zacks Rank buy for Microsoft. And the very first thing that clicks in my mind is that we have this trajectory for FY1, 2, and 3 EPS growth. And I want to utilize the Zacks Rank itself or any changes that I see to the Zacks Rank from a day-to-day basis. I want to see how that actually is going to impact the estimate trend. So the very first thing I do is go up to estimates, EPS, FY1, FY2 revision trend. And I take a look at the likelihood of this stair-step increase in EPS estimate forecast for both F1 and F2. What is the likelihood of that trend going to be to continue on in the future? And the fact that I have a Zacks Rank buy is a pretty good indication that I can expect, at least in the near term, for this trend to continue. And as I had stated earlier, the primary use case for the Zacks Rank is more of a short-term timing indicator, right? These forecasts are normally good for roughly 1 to 6 months. However, when you utilize it in this capacity, what we're doing is we're using it for longer-term trend confirmation or breakdown. And so this is a very, very different use case, a very unique use case for the Zacks Rank, one that I've been using successfully for years. And so where do we go with this now? So I'm going to take you back to the price and earnings page, and we're going to activate the valuation model. And when you click on the valuation model, it's actually going to be driven by the price and earnings view. The only difference is you get a normalized earnings trend line, and you get a new bottom panel that features all of the Zacks Valuation Model inputs and outputs. And you'll remember immediately from our part 2 of the Lost Decade series, here's where we made those changes to those macro factors. So keep in mind, again, the valuation model being a 5-factor model, we are not going to make any changes to the macro factors today. We're going to hold these factors constant. And what we're going to do is we are going to establish a base valuation for Microsoft using the company-specific factors, the growth rate, and the level of earnings. And then we're going to basically solve for a high and low range. So we're going to do our own interactive sensitivity analysis. And it was triggered by the fact that we, in default, will be modeling consensus estimates. But because we have a Zacks Rank buy, the likelihood of us experiencing an increase to our estimates in the near term, again, over the next 1 to 6 months, is on the rise, right? So what is this Zacks Rank telling us? It's basically a neon light or an indicator to us to say, hey, we've got activity taking place in the underlying estimates. In this case, because it's a buy, we've got positive activity. And again, this activity could be any number of things. It could be the revision agreement, right? All analysts revising estimates in the same direction. It could be magnitude itself, so large percentage change in the mean EPS over the recent past. It could be upside potential, right? So that's going to be based on the most recent EPS and how it differs from consensus. And again, it could be also contributing to the fact that that Microsoft in the past has experienced strong upside surprise. Okay, so it can be any combination of those factors. The point being is we need to look at this and we need to model it. So to establish our base case, what we're going to do is we're going to set the model into default, and we're going to acknowledge the sell side EPS growth forecast and the inputs, right? So we've, again, got all of our macro factors set to default. We are modeling an 873 EPS F12M number for Microsoft. We know that the Zacks Rank is a buy, so immediately I want to bias these numbers to the upside. But before we do that, again, I want to see what my 1-year expected return is going to be based on the 873 and whatever the implied buy-side bid devaluation is right now for Microsoft. So we've got a price of $289 right now on Microsoft. This is based on the most recent close. And we've got a model price of $201.96 and a model PE of 23.15. So our base case based on the default sell side estimates for growth of 1109 tapered by 1 standard deviation, bringing that all the way down to 8%, was far too aggressive. And I know that because the model is so far out of equilibrium, right? I've got a model price of 201. We're currently trading at almost 290. And if we were only going to grow at 8%, my model PE would only be 23. Well, we're trading at a 33 multiple, right? So as a measure of conservatism in default, my settings were too aggressive. And so what we need to do is we need to solve for the growth rate that more or less puts the model into equilibrium. We know we need to do that because these estimates are revised daily, and we have a Zacks rank of buy, and we're going to be actually biasing this to even the upside from here. So the only thing that can really be out of equilibrium at this point would be this growth rate, okay? So what we're going to do is we're going to activate the normalized earnings trend line, and we are going to just simply start raising that growth forecast. And what I want you to see is that for every single click that you make, it's going to raise the growth forecast by 10 basis points. And you'll see that that current model return begins to approach zero. And as that's happening, model price is approaching actual price, model PE is approaching actual PE, and we can force this relationship by just simply clicking this market implied growth rate button. And at that point, your current model return is forced to zero. That sets the model into equilibrium. When it's in equilibrium, you'll see that the model PE equals the actual PE, the model price equals the actual price, and we end up with a buy-side implied bid to valuation of 11.88% long-term earnings growth for Microsoft. And so this establishes our base case of our one-year expected return of roughly 12.62%. Okay, so that is what we can expect the return for Microsoft to be 1 year forward based on these consensus estimates. Right now, an F12M point of $8.73, right? So the idea is, how do we use Zacks Rank buy specifically to more or less model what our expected return could be in 1 year if the estimates come in at the high end of the range? And what I like to do, and I want you all to think about this, is I like to do something that is a little bit different than everyone else, right? Everyone else is really focused on where earnings are going to be 1 year forward. And you'll see that we've got a fiscal year end of June for Microsoft. I like to go out full 2 years, okay? Because this is where the rubber really hits the road, right? If everybody's already baked in their forecasts and everybody's pretty solid about where earnings are going to be for Microsoft 1 year forward, then the real money is going to be made trying to figure out where earnings could potentially be 2 years forward. So if I have a Zacks rank of buy, and I have a good confidence that this, and I'm going to go ahead and save these model settings really quick. I just wanted to show you this again. This Zacks rank of buy is telling me that this stair step revision, at least this trend, is going to continue for the near term, okay? So what I want to do is I want to assume that that is going to continue. And as such, these estimates could potentially come in on the high side for 2023. If that happens, what would my 1 year expected return be if, in fact, my 2023 estimate of 1050 were realized? Well, right now I can see that I'm modeling 964 for 2023. So again, recall that our base case for valuation is a 1 year expected return of about 12.62%, and that's based on consensus estimates for FY1 861, for FY2 972. Again, in default, all we're doing is taking a forward 12-month interpolation between FY1 and FY2. So we're effectively modeling 972 and 861 in default. That's where this 1262 is coming from. Now what I'm going to do is I'm going to physically take this normalized earnings trend line and I'm going to lift it from this 972 all the way up to basically this 1050. And keep in mind that to do that, all we're going to do is this arrow tool, activate it with a single click, and then use the arrow key on your keyboard to begin bumping up the estimates. Each click is a penny, and my eyes are focused right here on 2022, or 2023, I should say, the 995 going to 10. We're going to go to a full 1050, and I want you to see what's happening to that 1 year model return, okay? and you can see that I went over and I'm at 1050. So because we have a Zacks rank of buy, I want to start biasing my estimates to the higher end of the range. And I can see that my 1-year expected return has now gone to 22.59%. If this Zacks rank of buy is a trend indicator and that stair-step estimate revision trend continues and we start moving more towards the high end of this estimate range, that's what I can expect my 1-year model return to be, okay? So if we happen to have a trend breakdown, I want to know what that low end is going to be as well. So to do that, I'm just going to literally bring this 2023 1050 point down to 850. Okay, so again, I'm just going to hold that arrow key down on my keyboard and just run that 2023 number down to 850. And we're just doing some real rough sensitivity analysis to try to get some sort of a range in valuation for what we can expect Microsoft to be at in a year based on these estimate forecasts. I've got a really good indication that estimate revisions are going to continue strong in the next 1 to 6 months because of Zacks rank of buy. But because I see this, that's a trigger for me to redo this scenario analysis. And so you can see at 850, I've got a model return that's going to be basically negative 56 bips. And I would say that's best case scenario, right? Because what's going to end up happening is if Microsoft starts coming in at the low end of these estimates, the buy side is going to bid this model EPS growth rate down, okay? So this would be a best case scenario for Microsoft to sit flat. We would probably see a substantial price decline. And we can certainly model that scenario as well. We're not going to do that on this call. Again, the idea for this call is to understand how I utilize the Zacks rank by the unique nature in which I utilize it to bias my estimates for that FY2 point to more of the high range to see what that 1-year expected return is going to look like. So we established our base case valuation, right? Our base case valuation was very simply based on the consensus. And that was, we set this back to default, click on the market implied growth rate. We got a 1-year model return of 12.62% based on consensus. We brought the 2023 FY2 earnings up to 1050. We got our high end of the range. This is very, very simple, only takes a few minutes. 2259 1-year expected return. And if we want to model worst case, we model the low estimate of 850. And again, just using that arrow tool on your keyboard, the down arrow, bring that 2023 estimate all the way down to 850. And you can see that we're roughly at slightly negative 56 bips. So very, very easy to do this type of sensitivity analysis using the valuation model. Let's take a quick look at Apple. Another example. I'm looking at Apple here because it has a Zacks rank strong buy, right? This is a pretty elite class. Only 5% of our universe of over 4,000 stocks is going to have a strong buy. And so it's got my attention. I want to know what's happening at Apple very quickly. I click on default, right? I've warned everybody before, you've always got settings in there that you don't realize you were playing with Apple and it saved it. And so you want to set it to default. I can see that in default, I've got an 11% forecast growth rate coming in from the sell side. That's -1 standard deviation. That's actually pretty tight, but I can see a current model return of 20%, which tells me that the buy side is not even paying 11% growth for Apple. Wow. That could potentially be an opportunity for us as well if we think Apple's going to grow faster than that. So what I'm going to do is I'm just going to click on the market implied growth rate, right? I'm going to solve for, based on the current price, based on the current level of earnings, what that growth rate is that would set this model into equilibrium. So the buy side is paying roughly 9.16% growth for Apple. And you can see that results in roughly a 9.06% model return over the next 1 year. So if I've got a Zacks rank strong buy, what's the very first thing I want to take a look at? I want to take a look at estimate trend, because if estimate trend is going to continue and it's going to be solid, I want to know that. So I want to take a look again at this EPS FY1 estimate revision trend. And I do want to save the model changes that we just made. And you're going to see again a very similar scenario that we looked at for Microsoft. This stair step every 3 months, every quarter. The fact that we've got a Zacks Rank strong buy, right, which is the equivalent of a Zacks Rank 1, tells me that this trend may continue, right? So I want to model the high end of those estimates. And in doing so, all I'm going to do is I'm going to come out to this 2022 point. Keep in mind, I've got a fiscal year in September, right? So 2022 is going to be a fiscal September 2022, so not nearly as long as what we did for Microsoft. But that's okay. Let's just take a look at what 630 would look like as the high estimate. And keep in mind that our base case scenario 1 year is 9.06% expected return. So this is the number that you would want to compare to, Bloomberg's 1 year expected return. Keep in mind that a lot of these third-party providers, all they're doing is taking an average of sell-side price targets and more or less presenting that to you as a 1 year expected return. And we know, right, from our discussions in the past that those price targets can be aggressive if left unchecked. So utilizing the Zacks Rank with the valuation model in this capacity can be a really, really good way to more or less validate or otherwise challenge what you're getting from those other third-party providers. So what we're going to do is we're going to run the 2022 estimate up to 630. You can see that right now I'm at 572. So I'm just going to run that up to 630, and you can watch our 1 year model return come all the way up to almost 20%. Okay, 20% return. That's 20% upside in 1 year if we start approaching that high estimate. Likewise, I want to model this 505, even though I've got a Zacks Rank strong buy, right? We're doing scenario analysis, we're running sensitivity analysis here. Let's see what the 505 looks like. And again, I'm keeping that model EPS growth rate constant because I know that's what the buy side is currently bid Apple's valuation to in terms of long-term earnings growth. So I'm going to bring that 2022 number down to 505, and you can see that results in about a negative 4% return. And keep in mind, again, that's going to be at best, right? Because if Apple starts bringing in numbers towards the low end of the range, this implied bid to valuation the buy side is currently paying 9.16 for is probably going to go down. And again, we can model that. I'm not going to do that in this call, but this is going to be your best case, okay? So it gives you a range of valuation. And again, that is how I use the Zacks Rank. Let me show you one more example of a trend breakdown, right? Amazon. And again, the value here in the Zacks Rank for many is timing. But what happens if you already own these companies, right? A lot of these names are core portfolio positions. And when you see these Zacks Ranks go from hold, which, in the case of Amazon, it just went from a hold to a sell, does that mean that you immediately sell it, or do we just need to lift the hood and look into this a little bit more? Now, keep in mind that when we're looking at trend breakdowns and trend reversals for a company like Amazon, we want to, acknowledge the fact that we brought forward a lot of growth through COVID. And I was very shocked when Amazon reported and the response was, well, I thought Amazon was going to continue to grow at 40%. I never thought that, but certainly a lot on Wall Street did because they sold the stock off. The forecasts that we had at Zacks were always here in the upper 20s. And so as far as normalized earnings growth goes, that's really where my expectation was the whole time. So again, I'm trying to walk you through kind of a portfolio manager's thought process here as they're looking at a Zacks Rank of sell for a holding that we would currently own, say as a part of the ECP macro tilt family of 6 names, which is where Amazon resides. So when we look at the estimate trend, right, this is where we can see a breakdown, right, for Amazon. We had these lofty expectations built up that this COVID, recovery or these earnings that were pulled forward through COVID would continue. And clearly that wasn't the case, right? So we're just normalizing that earnings trend back out to that upper 20% range. So is this really a reason to sell? Not necessarily. What it tells me is that we've got a little bit of a trend reversal and we need to keep our eyes on this, okay? So now what I'm going to do is I'm going to go immediately to the low side of Amazon. I'm going to model the low side of Amazon's estimates first. We've got a real dispersion in the estimates here for Amazon. So I'm not going to go through the actual modeling. I did it in advance of the webinar, and I'll read you the numbers in just a moment. But let's go ahead and solve for the default at any rate. And you can see that when we solve for the market implied growth rate, that the buy side is actually paying somewhat less than consensus forecast for long-term growth. So the consensus estimate for growth long-term, 3 to 5 years, is almost 28%. And you can see that 28, 27, 34. The buy side has already bid that implied valuation down to only a 16.92% rate. And you can see the dispersion here across the high and the low. So it's always a good idea to model that, especially when we're looking at a trend breakdown that really is not necessarily a trend breakdown. What it's doing is it's getting us back to that normalized earnings growth range. So when we model Amazon's low point, that 1 year expected return is actually negative 15.88. Again, that would be at best. So that would be basically us modeling this 47.75 on the 2022 estimate. And when we model the high end of the range, this is what everybody talks about, right? When you start talking about, Amazon's advertising growth potential, which is what, has gotten me really excited about Amazon. When you start looking at these high end of these estimate ranges, you're talking about a 1 year expected return of almost 46%. So there's a huge, huge range for Amazon. You've got the low estimate coming in with a 1 year expected return of negative 15.88. You've got the high estimate of 82.08 coming in with a 1 year expected return of 45.58. And you've got the consensus forecast coming in at 14.51. Okay, so this is our base consensus estimate forecast based on the market implied growth rate that the buy side is currently bid Amazon to. So huge, huge value in establishing your base scenario that we just did for Amazon and then solving for this high and low range. When you listen to CNBC and you read the Wall Street Journal, you'll hear everyone talking about this 30% upside for Amazon. You can see exactly where that's coming from, right? It's coming out of these estimates, at the high end of this estimate range for 2021 and 2022. We just solved for it. The number that we get is about 45%. And I would encourage you to compare those to, your Bloomberg expected returns or any other third-party provider, even your own proprietary models, to see how those pencil out. But keep in mind, our base case scenario was for about 14.5. The high end of the range, again, 45. The low end of that range at negative 16%. So anyway, that's about it for this week. If you found this video helpful, please hit the like button below and be sure to subscribe for future videos. If you have any questions or ideas for future videos, please leave a comment below or email me at tnyland@zacks.com. You can also follow me on social media. I'm on LinkedIn and I'm on Twitter at Tim Nyland. If you're interested in getting started with Advisor Tools or ZRS, or if you're interested in upgrading your current subscription, please contact our world-class support at advisortools@zacks.com and ZRS@zacks.com. There is no PowerPoint presentation available this week. I apologize, but if you have any questions, feel free to reach out to me or my team. Thank you for watching, and I'll talk to you all next week.